Hi, in today's class, we're going to be learning the concept of operating leverage. In operating leverage, fixed cost acts as a lever to improve the operating profits. So in today's sum, let's prove this concept of operating leverage. Following is the cost information of ABC Limited, wherein the fixed cost is 50,000, variable cost is 70% of sales, sales is 2 lakh in the previous year and 2 lakh 50,000 in the current year. Find out the percentage change in sales and operating profits when there are no fixed costs, which is a non-leveraged situation, and when there are fixed costs, which is a leveraged situation. So let's prepare an Excel sheet wherein I'm going to prepare an income statement for my previous year values, current year values, and the percentage change column. Now, since they've given us sales, we're going to start our income statement with sales. For the first option where there are no fixed costs, I'm going to prepare the income statement. Starting with sales, they've given us the sales value of previous year as 2 lakh and current year as 2 lakh 50,000. So I'm going to copy these values into my statement. Now, how do you calculate percentage change? I use a very simple formula, which is difference divided by base into 100. Difference will be difference between the two values. Base will be the previous year or the year based on which you find out what is the percentage change. So in this case, the difference between both the sales values is 50,000 divided by base, which is your previous year value, 2 lakh into 100. Now this gives you a percentage change of 25%. Next, you deduct the variable cost, which is 70% of sales. This is given in the question. So calculate 70% on the sales value of both the years. And the percentage change of variable cost will also be 25%. Try it out using the formula. Now, we all remember sales and variable cost move in the same proportion. And that is why the percentage change is the same. Now, once you deduct variable cost out of your sales, the answer you get is known as contribution. Contribution will be your sales minus variable cost. So I've done the deduction in both the columns and I've got contribution of 60,000 and 75,000. Now you'll notice that the percentage change for contribution is also 25%. It's simply because sales minus variable cost gives you contribution. So if sales and variable cost move in the same proportion, your contribution is also going to move in the same proportion. Now the next step is fixed cost. Now fixed cost is given in the question as 50,000. But in the first scenario, there are no fixed costs. So we're going to try out a scenario where there is no leverage. So I'm going to take fixed cost as 0. Now what happens to my EBIT? My EBIT remains the same as my contribution. And therefore, the percentage change in my EBIT is going to be 25%. EBIT is also known as operating profits. They asked us to find out the percentage change in sales and operating profits. So in the first scenario, which is a non-leveraged situation, my sales and my EBIT are changing by 25%. Now let's move on to the second situation where it is a leveraged situation. So now since we already know that sales, contribution all move in the same direction, there's not going to be any change in this. I'm going to copy and paste the same thing. Now, once we come to the fixed cost part, this is where we consider the fixed cost because it is a leveraged situation, 50,000 each. Now, what happens once you deduct your fixed cost? Your EBIT is going to be 10,000 in the previous year and 25,000 in the current year. Now, let's use the difference the percentage change formula to find out what happens to the percentage change in EBIT. So difference 15,000 divided by base 10,000 into 100. You will notice there's a 150% change in EBIT. So you notice because fixed cost remains constant, even when sales has increased, your EBIT increases at a much larger proportion. And this is the advantage of having fixed cost. So this is a leverage situation we are talking about. With this sum, we've proved that in operating leverage, fixed cost acts as a lever to improve your operating profits. Now, because fixed cost is so beneficial, you also have to ensure that you can't have too much of fixed cost. Because once your fixed cost is too much, you will not be able to recover these fixed costs with whatever revenue you get. So therefore, remember that this fixed cost cannot exceed a certain limit. And if it does, you will reach a situation called as operating or business risk. Business risk or operating risk is the shortage of funds to meet your fixed operating expenses. So always remember, although operating leverage can act as an advantage, you can't have too much of fixed costs because then it will become a disadvantage, which is operating risk. Thank you.